everyone, good morning. You're watching Buy Now, Sell Now on ET Now. I'm Mubina Kapasi joining in place of Karunya Rao for today, and along with me, of course, is your usual 11 a.m. anchor, Varun Hirimat. Hi Varun, good morning. Well, the opening cues for the equity markets had actually started off on a very positive note. Pre-open session indicated that the Nifty may go beyond 13,200, and yes, we did have a good start, but we've ebbed off quite considerably from those highs, as the Nifty now in fact is just about near the low point of the day. Nevertheless, still with 0.25% of gains. But here are the big headlines we are tracking for you. A vaccine is finally here. The Serum Institute of India is said to have told the Economic Times this morning that they may start selling a COVID-19 vaccine from March or April of 2021. That's just roughly 3 to 4 months from now. This, of course, after the United Kingdom announced an approval for the vaccine. They may start, of course, distributing the vaccine from next week itself. Meantime, for the equity markets, we're steady above 13,000. PSU Bank, metals, these are the counters that are driving the up move in trade today. And it is metals really that continues to be on fire. We at ET Now have been telling you about how steel companies have been hiking prices. The metal index on the back of that as well continues to outperform. The index has surged more than 30% in the last 2 months. JP Morgan is overweight on Tata Steel, JSW Steel and Steel Authority of India. In fact, they have an ambitious target of 700 rupees for Tata Steel. And last week's outages at HDFC Bank have prompted the RBI to order the bank to halt all new digital launches, including new credit cards. But the bank, however, says that business is not impacted. Well, lots of block deals and bulk deals this morning. We have Standard Life that is selling 2.79 crore shares in HDFC Life, and this morning we saw 1.38% of equity trade in a single bunched trade. Remember that as of the 30th of September, Standard Life held a little over a 10% stake. They've been steadily divesting their stake in HDFC Life since January last year. So far, they have divested nearly 19%. And brokerage share for SBI. CLSA has maintained a buy with a target at 360 rupees. The target price has been lifted by 30 odd rupees. Their deep value report, of course, had as well highlighted their conviction in SBI a couple of months ago. And since then, the stock price has gone up by 25%. CLSA nevertheless does expect valuations to continue its mean reversion course.
Okay, let's take a look at how the markets are faring this morning. We have clearly sold off from the morning. We opened up the SGX with a 100-point gain. Looked like we were going to have a big day today and possibly inch back toward our lifetime high, but we have just seen some selling pressure. The breadth is also, while still positive, showed a little more favor towards the decline. You now have 16 of the Nifty 50 declining. We're at 13,150, so that's still respectable. Unfair to say that we've really sold off, but that morning fervor is kind of missing. In terms of what's leading any kind of up move that we're seeing, SPI on the back of that CLSA upgrade, 257, up 4.5%. We have Maruti gaining nearly 4%. Like Mubina was mentioning, metals are just on fire. So you have Tata Steel, Hindalco today gaining really smartly. And then you have ONGC as well doing quite well. On the losing side, you have an SBI Life, you have an Ultratech Cement, a Bharti Airtel, an Infosys, and a Bajaj Auto. So literally one heavyweight from each sector, whether you look at financial, cement, telecom, IT, or then auto. So no clear trend visible today. All the benchmarks are okay. The bank index is still up around 0.75%. The auto index is up over 1%. The mid-cap index is up 1%. So I think we're just seeing some selling pressure in very select names. So that's just how the market's faring. A quick update for you. Let's also just address the quiz question for this morning. You guys still have 40 minutes to answer our question. We've asked you today, which is the third largest hotel chain in India out of the listed players? if you look at number of rooms as a classification. So Indian hotels, EIH, which is Oberoi, Lemon Tree Hotels, and then Chalet Hotels are your options. Do tweet to us on the ET Now handle, and you have 40 minutes, and if you're correct, we'll feature you on our channel at 11:45. Now that we're done with that, let's address an all-important story regarding the heavyweight of heavyweights as far as banking is concerned, HDFC Bank. Bit of a tizzy this morning. We suddenly got a notification from the exchanges that HDFC Bank has been banned from, or really halted from, launching its new digital platform. It has been halted from adding new credit card customers, and this obviously got a lot of heads turning. And then you go through and you study the commentary from the bank, and you understand that this is more to do with some outages they've experienced in their digital platform. So the main server crashed last week, November 21st. They had some issues with conducting transactions. So on account of that, RBI has had to step in and said that, listen, till you sort all that out, delay the launch of your digital platform, and you're not allowed to add any fresh customers. This will not impact any existing customers. All of you who are currently transacting digitally on HDFC Bank platforms are safe. It's only for the new customers, so that they figure out the system bandwidth before they add more customers. So that's just an update for you. Stock seems to be holding up fine. We've written to the bank. They might talk to us later, but as of now, what they've said is that this will have no material impact on their near-term business. So investors, rest assured, nothing to be alarmed about at HDFC Bank. But over to you, Mobina. I think it's time to talk fundamentals and technicals with our guests.
Oh yes, absolutely. And of course, along with that, get the questions and queries we've received from our viewers as well answered. So let's welcome on the show Kunal Prabhakar, as well as Kunal Bothra, pardon me, and Mr. A.K. Prabhakar, the head of research with IDBI Capital Markets. Gentlemen, good morning. Thank you for joining in. Kunal, let's start off with you first. The last 2-3 days have seen the market sort of attempting to make new highs, but then cooling off from those levels. What do you think is causing this resistance of sorts? And of course, while we're at it, also share with us your high and low risk ideas.
Well, absolutely. So, good morning, Mobina. I believe that one of the reasons why the indices are taking a bit of its own time is some derivative parameters, which I believe is acting as a bit of a hurdle for the index, or a bit of a pause for the indices. One of them is the lack of or the drop of open interest. We've seen the last 3 days, I think, except for yesterday, where we saw some built up of positions. In the last 3 days, there was some reduction to the open interest for the indices, as well as many of the derivative parameters like the put call ratio had got back into a overbought territory. So I think till day before yesterday, when the markets were at their all-time high levels, the put call ratio had gone back to 1.7, 1.72 zone. These are overbought kind of territories for the PCR ratios, and that generally indicates that it could probably warrant some bit of cool off or time correction into the indices. So I think that's been one of the reasons why I believe that the indices are taking its own time. But largely when you look at the intraday rallies, when you look at the intraday falls, and then the comeback of the indices, I think it indicates that the bias is still on the bullish side for the index. So even though there could be a bit of choppiness and volatility, but I believe as a directional play, traders could probably continue to initiate buy calls even at current levels. Now, there are two set of buy calls which I want to initiate at this hour. First one would be from a high risk trade. It's a Piramal Enterprise. Now this is interesting because the stock is coming out of a deep consolidation over the last, I think 1 or 2 months. Also, if you look at it comparatively as compared to its other peers, Piramal Enterprise has underperformed. So I believe that there should be a significant catch up to the stock price in the near term. Hence, I would suggest a buy. Would term this as a high risk trade purely because of the high beta nature of the stock. So a buy on Piramal Enterprise, targets to be kept at approximately 1500 plus, and stoppers could be kept at 1425. The second would be a buy on HCL Tech. Now, in the morning, as well as yesterday, I was indicating that many of these IT stocks are looking quite attractive on the charts. You're seeing some buying momentum coming back into the IT names. So I would believe HCL Tech could be the other IT stock from the IT pack, which could do pretty well for itself in the near term. The stock is at 859, 860 levels. I believe from a near-term view, traders could expect a 900 target range on HCL Tech. Would suggest this as a buy. Stoppers could be kept at 840 levels.
Okay, thanks for that, Kunal. Hi, Mr. Prabhakar. How are you doing? What's on your radar today? Is the risk reward looking favorable to you? And then based on that, what would be a more risky idea for our viewers and what would be a relatively safe idea for our viewers this morning?
I think the bull market momentum is in a very high swing. So there is always an opportunity in this kind of market. I think our exports to China, rice exports to China has increased. Almost other than basmati rice export, this year has been good by 65%, higher by 65%. After 30 years we are exporting. So I think short term Dawat or KRBL, which are linked to rice, will do very good in short term. And the news which came in HDFC Bank, I think that is likely to be positive for SBI cards. Today all PSU banks are doing good, so that momentum can continue for some more time. Long term, I am positive on hospitals. I have selected Max Health as the hospital which I like, which has almost 16 facilities and 3,400 beds. So the promoter group Radiant holds 49%, and the MD and CEO Abhay Soy, he holds about 23.3%. So, and they have a margin of above 16%, and the capacity utilization has also improved. So Max Life is my long-term bet, but short-term there are many stocks which are looking good, and we need to be with momentum.
All right, thanks for that, Mr. Prabhakar. Let's now bring on board our consulting editor, Maithili Busnurmat, who's here to talk on the HDFC story as well and share her view regarding what this might be, what these restrictions imposed by RBI really are, and whether they're likely to have any material impact. So good morning, Maithili ma'am. Thanks for joining in. How serious is this for HDFC Bank? Is the market preempting something? Stock seems to be holding up fine. Is it more to do with them fixing their systems, or is there a regulatory concern over here?
No, I would imagine that it's more to do with them fixing their operating systems, because there have been a number of instances of outage in, when it comes to their internet services, their banking, mobile banking, etc. And there was a major power failure in the primary data center on this November 21st. So RBI, the regulator, is naturally concerned that transactions should go through and there should not be any problem because of operational issues. So this is I would say RBI has done the right thing in telling the bank that you hold your services, getting fresh customers for a credit card, etc., until such time as you get your house in order. So I would not think it's any long-term issue, but certainly it is a signal to the bank that you need to be careful even as you expand. You need to be sure that your systems are able to cope with a higher number of customers, a higher load, etc. So I think this is just a warning to the bank to ensure that it has its systems in place.
Okay, Maithili, thank you so much for that. Well, let's address the questions and queries then that you guys have written into us. First up, we have Sanya Mehra from Mumbai, who writes in saying, is it a good time to buy hotel stocks? Should I invest in EIH or Lemon Tree? Both of them small cap stocks. Kunal, let's first get in a technical take. On the fundamentals, of course, there's lots to talk about around these hotel stocks. But, while Sanya has not, of course, spoken about Indian hotels, I'd like to throw that in the mix as well. What do you make, since there are just these few chosen names in the listed space for investors to choose from, do you think that this is a good entry point for any of these three counters?
Well, absolutely. I for one believe that the hotel space looks very attractive, and many of these stocks from the hotel space looks attractive from a long-term view. I think the focus, which at least I would recommend, should be on Indian hotels, because I think that's been one of the stocks which has shown a lot of durability and a lot of strong uptrend over the long-term charts. I remember clearly, I think 2019, for a good part, the stock was trading at 160 levels. During the COVID correction, the stock fell very sharply and came back to sub 60 kind of a zone. From there on, we've seen a very strong recovery for Indian hotels. So I think out of the hotel pack, I for one believe that Indian hotels is one of the stronger names. You look at the last 6 months of price trends, you look at the last 3 months of price trend as well. That will be a clear indication of an outperformance which has been shown by Indian hotels. In fact, just a month back, the stock was trading at 100 odd rupees, trying to consolidate, and now the stock has jumped up to almost 125, 130 rupees. So that's the kind of returns the stock has shown historically as well. So I would be bullish on the space, and I think from the stocks which you mentioned, I would probably want to add Indian hotels as the other stock, and I think that should be one of the primary stock which you should be looking at from the space.
Okay, thanks for that, Kunal. What about you, Mr. Prabhakar? Do you think that the hotel space is as attractive? And given that Indian hotels has run up the most and is now closest to its 52-week high, EIH and Lemon Tree possibly offer more upside, or would you stick with the winners?
See, Indian hotel is not comparable with other. I agree with Kunal. So, it is the leader in the listed space, and I think, the way they are expanding now, recently, about 2 days back also, they signed an agreement for east part of India with few groups. So, they are going on a asset-light model, where they will be managing the business, whereas the property belongs to somebody else. So asset-light model is going to be the winner from here on for Indian hotel, and after the change in new management, after Mr. Puneet Chhatwal has taken over, there are a lot of changes happening. Even in this COVID thing, they are able to generate a good revenue, and I think once the COVID is over, they will come back to normal. So the leader, always we need to be with the leader, but if we want to go with slightly down, I think Lemon Tree is a very good bet. Now, Lemon Tree also, they will come back very strongly, and the bad time is a good time to buy stocks like this. So I think hotel is a place to buy.
Both our guests very upbeat on hotels. Obviously, Indian hotels is the prime pick and the favorite, but you can look at a Lemon Tree as well. It should bounce back smartly. So that's a good one for our viewers. Now, the next query is also very interesting, and it's from Rakesh Yadav of Patna, who's written to us. And, it's someone who's looking at the Tier 2 segment of financials. So he doesn't want to look at Tier 1. He's mentioned banks like IndusInd Bank, RBL, he's mentioned Cholamandalam. And what he believes is, again, that they've run up less than the leaders. So Kunal, coming to you first, how do you feel about these Tier 2 financials? Do you think it's a value trap? Can an IndusInd or an RBL ever get back to 4 times price to book? What would your advice be?
Very, very, I would say good question from the viewer and from you as well, Varun. There are 2 reasons why I believe that, the markets have been, rewarding to the large cap banks as compared to the Tier 2 names or the, Tier 2 large cap names or the mid cap names in that same breath. One of the reasons why I believe is the FII buying, which has happened to full throttle. And generally we've seen the behavior of FII buying, that it gets restricted more towards the large cap names, or gets skewed towards more large cap names. So I think which is why you saw HDFC Bank, Kotak Bank, particularly these 2 names which have shown very strong outperformance. But even in the large cap banking names, you've not seen all the stocks doing exceptionally well. So for example, ICICI Bank is still lagging behind. I think if I'm not wrong, if my memory serves me right, the all-time high for ICICI Bank was 550, and the stock is at 475, 480 levels. So there's still a lot of underperformance, from ICICI Bank in the same breath. I, for one, believe that if you're looking to buy the banking space, then I believe concentrate more on the large cap names first. If you've done that buying, for example, if you've bought, for example, HDFC Bank or a Kotak Bank, only then you should probably scale down and look at the high beta pockets. Because of the recent underperformance, it's possible that the likes of IndusInd Bank and Axis Bank and RBL and Bandhan Bank, etc., they could continue to underperform, and the leaders can get more traction. It's only when you see a euphoric price up move is where the markets give more premium, or the price activity is more higher to the mid cap banking name. So as of now, I believe that the large cap private sector banks will still gain more traction. HDFC Bank, Kotak Bank could be the top 2 favorites in that regards. You can probably look at even an ICICI Bank in that aspect as well. From the mid-cap banking space, I would believe that maybe an IndusInd Bank and an RBL Bank could be the 2 high beta pockets which you can look at.
Okay, let's go across to Mr. Prabhakar now. IndusInd, RBL, Cholamandalam. Essentially, financials is what Rakesh is very interested in knowing more about. And IndusInd Mr. Prabhakar, has really outperformed, in fact, the Nifty Bank as well in the last couple of trading sessions. What do you think of, financials at this point of time as an investment?
Till the NPA classification is not done, there is always a risk in these financials. But anyway, they have selected Cholamandala, where they are very clear in what is happening in their books. Even Bandhan Bank has told what is happening. So you have to be with the large cap, which is HDFC Bank, ICICI or Kotak. Otherwise, you have to know what is the risk you are taking. When you take IndusInd Bank or RBL Bank or Bandhan Bank, there is an inherent risk once the classifications start to come. See, the way banking is running up, I think, when the correction comes also, there will be that kind of risk. Understanding the risk, if we can buy, at least in short term, there is good money to be made in these counters. But long term, I will not be positive on these second line banks. I'll be positive on the large caps only.
All right, thanks for that, Mr. Prabhakar, and a big thank you to you both for joining us this morning. Appreciate it as always. It's time for a quick break now, but as we get into it, let's get you a slice of market veteran Saurav Mukherjee and what he had to say on the momentum he sees in financials, and then we'll be back shortly.
Both the private sector banking space, including PSU banks, and the NBFC industry is set for significant consolidation, right? And in a way, just like the aftermath of Demon, just like the aftermath of GST, I think the post-COVID aftermath will also be a trigger for consolidation. The obvious aspect of consolidation in banking is the PSU banks ceding share to the private sector banks. I think that's an ongoing process that will probably continue for the next decade or so and benefit shareholders in private sector banks. I think that the bigger call is the NBFC industry consolidation. Our reckoning is the NBFC industry will consolidate around, say, a dozen champion franchises, of which we are invested in, say, arguably the strongest of them, Bajaj Finance. But you could argue, make an argument for, say, an LIC Housing Finance as well. Where we are still hesitant to invest is, say, one rung below. We're hesitant yet to, say, invest in a Cholamandalam or a Shriram Transport. But I've met other investors who believe that if the CV cycle recovers, Shriram Transport will do well, and they're therefore investing there. Whichever way you cut it, whether you invest in absolutely the elite NBFCs or one rung below, it is, I think, fairly clear that over the next 3, 5, 10 years, the industry will consolidate, much like private sector banking has consolidated. If you see private sector banking, 4 banks account for 90-95% of the industry's profits. I think we'll see a similar phenomenon play out in the NBFC sector. And if I was an ET Now viewer, I'd be positioning my portfolio to make money from that. Whether you buy a Bajaj Finance or an HDFC or an LIC HF is your prerogative, but it would be a shame if you don't benefit from this consolidation. Just like in private sector banking, I'm very, very confident we'll see NBFC industry profitability crunch in the hands of a handful of lenders.
Hello, welcome back to ET Now. You're watching Buy Now, Sell Now. Let's pull up a very interesting chart today, particularly because it's up almost 5%, and that's SBI. CLSA, if there's one broker that's the most bullish on SBI, it's definitely CLSA. 3 months ago, they put out a note on SBI called 5 Reasons to Buy. They then upped the target price from that note. Now, today in the third note, they're further upgrading SBI to a target price of 360 rupees, which means even from here at 250, you have 110 bucks to go, or 40% upside. They believe that SBI will probably do a 10% ROE this year, and that the street is factoring in only 8%. Next year, they can do a 12% ROE. They also see that SBI is trading at 0.5x FY22 price to book, which they think is very cheap. Thirdly, because the corporate book is holding up fine and the collection efficiency in the retail book is so high, they think that slippages are going to come down considerably, and that is going to increase CLSA's previous earnings estimates for SBI by 12.5%. So what that basically translates to is 225 billion rupees of net earnings for SBI in FY22, which CLSA believes is just too cheap. So it's the third note. SBI has a lot of catching up to do before it gets to 360, but CLSA firmly believes it can get there. So keep your eye out for this one, and today it's definitely trading on some big volumes. We then have another bank which is in focus, HDFC, sorry, not bank, HDFC Life, excuse me, that's an insurance company. There's a block deal that must be mentioned. Standard Life is selling 2.79 crore shares of HDFC Life, and HDFC Life trades 1.38% of total equity. So that's the amount that's changed hands. As of September 30th, that's in Q2, Standard Life held a 10.27% stake. So now they've divested a total of nearly 19% in HDFC Life, and Standard Life will now raise up to 1,770 crore rupees via this block deal. So keep an eye out for that one as well. And of course, HDFC Life's a top pick in the insurance space. But metals are buzzing, steel particularly, and there's a big brokerage upgrade there, which Mobina is now going to walk us through.
Well, Varun, actually, it's yet another big brokerage upgrade. All these upgrades are essentially following the price hikes that steel companies have been taken, which in turn, of course, is because of the fact that we've been seeing steel prices around the world increase. And of course, not to mention, there's been this stupendous recovery in demand for steel in India. JP Morgan has upped their target price for Tata Steel, for JSW Steel, for Steel Authority of India as well, quite significantly. They are seeing a strong operating environment for steel companies, attractive valuations as well, and of course, not to mention that along with steel prices, iron ore prices as well are rallying. So obviously, for those companies who do have captive iron ore mines, the rise in iron ore prices should not really perturb them much. And among those companies, it's Tata Steel that, according to them, is best placed. Even as Steel Authority of India is considered as an iron ore proxy, but of course their volume of activity in iron ore is much lesser than, say, an NMDC. But yes, very ambitious targets as well for all the ferrous companies. And, we at ET now as well have been telling you about how these companies have been hiking the prices of steel. They've been doing so for the last, I think, 4 to 5 months consecutively. They hiked prices yet again yesterday and day before yesterday, the beginning of a brand new month. So steel companies are definitely going to be in focus. They're all, by the way, at a 52-week high, well, at least a majority of them. But it's time for our ET Now Insight segment, and today our colleague Jayesh Khilnani has BFSI on his radar. The March correction in markets due to the COVID-induced lockdown had, of course, had an impact on sector weightage in the Nifty. So BFSI's weight, in fact, slumped to a 3-week low. But that's history now. Amidst the economic revival, this segment has managed to regain its weightage in the Nifty to its pre-COVID levels. So Jayesh, take us through these weighted changes that we've been seeing since May.
The weightage of banking and financial stocks in the Nifty is almost back to its pre-COVID levels. If you have a look at the trend of this year itself, in Jan 2020, we were at more than 41% weightage in the Nifty, and from there on in March, we hit 38.85%. And had a major dip towards the 33.34 level mark in May 2020. However, from May, there has been a steady recovery and outperformance that we have seen from the banking and financial stocks. The weightage currently stands at about 39.28%, which is almost back to its pre-COVID levels. So interesting to note, which sectors have seen an increase in their weightage from their May 2020 low. You have the banking and financial sector, which has seen the biggest weight increase, almost 600 basis points on a combined basis. And you have IT stocks that have also made a comeback of more than 100 basis points. While on the flip side, which are the sectors that have lost some amount of weightage, you have FMCG that has been the top loser, more than 200 basis points lost over there. And you have telecom along with oil and gas that has also lost more than 100 basis points on their respective weightages. And that is courtesy the stock changes that have happened as part of the Nifty during this year itself. You have HDFC Life and SBI Life that have been added, and those have contributed to the financials aspect, while you have Divi's that has contributed to pharma, and what's been excluded is Vedanta from metals Bharti Infratel from the telecom pack, and Z Entertainment from the media pack, which unfortunately has no representation currently in the Nifty.
Okay, thanks for that, Jayesh. It's the all-important credit policy which happens quarterly, and tomorrow we'll know the latest stance of the RBI. But it's likely to keep interest rates unchanged amidst the steady pickup in retail inflation. Stance may remain accommodative as the central bank looks to revive economic growth. But my colleague Poonam, who has been looking at these RBI movements lately and over the last couple of quarters, is now going to walk us through the fine print. Over to you, Poonam.
Well, RBI most likely is going to keep a status quo in terms of the repo rate along with an accommodative stance. The reason being that there is persistent high inflation, both core CPI as well as the headline CPI remain high. Supply side pressure do persist. Also, recent GDP growth has been far better than expected, and hence there is a possibility that RBI goes ahead and even hikes the GDP growth projections along with even the CPI projections. Besides that, of course, we should be watching out for RBI's commentary in terms of the overall growth inflation dynamics. Banks have been also parking excess liquidity with the Reserve Bank of India, and hence system liquidity, which has remained nearly around much over 5 lakh crore on an average in November. There is a possibility that RBI goes ahead and hikes reverse repo rate marginally. Besides that, of course, watch out for RBI's commentary in terms of measures on the system liquidity front, along with the commentary on use of special OMOs. Some of the economists like Nomura does believe that RBI may possibly stay on hold throughout 2021 versus their earlier expectation of 50 bips repo rate cut in 2021. So we need to be mindful of that. Again, watch out for RBI's commentary in terms of the overall need of further fiscal stimulus and the effect of the recent stimulus. As of now, a status quo on rate, RBI could change the inflation as well as growth projections.
Okay, time for a quick break here on Buy Now, Sell Now. But when we come back, we'll have the answer to the quiz question and plenty more, so stay tuned. We'll be back in just a minute.
Welcome back. You're watching Buy Now, Sell Now on ET Now. In an effort to normalize everyday life post the COVID pandemic, like every other industry, the ride-sharing one is ensuring safety for all. Uber, in collaboration with the Times Network, presents Safer for Each Other, a campaign taking you on a tour of all the safety measures Uber has taken to fight the virus. Take a look at what's in store for you.
Safety has always been a top priority for Uber. And during the COVID-19 pandemic, the ride-sharing company introduced several new policies and features to help keep the riders and drivers safe. Times Network's Kranti Sambhav got up close and personal with Pawan Vesh of Uber to check out the new Uber experience.
First thing first, बहुत महीनों के बाद मैंने एक कैब में मैं बैठा था, बहुत अलग एक्सपीरियंस रहा था. What are the changes have you brought in अभी जब से पैंडेमिक शुरू हुआ?
तो सबसे पहली तो ये बात थी कि जब ये पैंडेमिक आया इसके बाद बहुत ज़रूरी था कि हम जो है राइडर्स का जो कॉन्फिडेंस है उसको वापस लाएं, जो ट्रस्ट है वो वापस लाएं. तो हमने ये डिसाइड किया कि जो हम करेंगे वो दिखा के करेंगे, बोल के नहीं करेंगे. सो वी विल शो नॉट टेल, राइट. तो इसमें हमने काफ़ी चीज़ें की हैं, और अगर इनको ब्रेकअप किया जाए तो देयर आर इन 3 एरिया। सबसे पहले तो जो हमारी ऐप है, जो टेक्नोलॉजी है, उसमें हमने इनोवेशन किया है। तो अगर आप ऐप खोलते हैं, सबसे पहले आपको एक चेकलिस्ट दिखेगी, राइट? तो जो भी चीज़ें आपको करनी है, आप मास्क पहन रहे हैं, हाथ धोए हैं, ये सब आपको वो रिमाइंड करेगा। उसके बाद अगर आप ड्राइवर हैं तो एक सेल्फी लीजिए, और अगर आपने मास्क नहीं पहना है तो वो आपको ऑनलाइन अलाउ नहीं करेगा जाने, राइट? तो ये टेस्ट है। हमने ये भी किया है कि जितनी हमारी गाड़ियाँ हैं उसमें आगे कोई नहीं बैठे, राइट, टू हैव सोशल डिस्टेंसिंग। तो जो सीट कैपेसिटी है उसको भी कम किया। और जैसे आप ट्रिप लेते हैं, ऐप में हमने सुविधा की है कि आप फीडबैक प्रोवाइड कर सकते हैं, स्पेशली कोविड रिलेटेड अगर आपको कोई डिफ़िकल्टी आती है। तो ये रहे ऑल द इनोवेशन इन द ऐप, ठीक है? और यहाँ तक कि जो राइडर जो है, अगर हमें फीडबैक मिलता है कि राइडर मास्क नहीं पहन रहे हैं, तो राइडर को भी सेल्फी लेनी पड़ती है। तो ये रही टेक्नोलॉजी साइड।
When it comes to safety, the work is never done. That's why Uber continues to develop new and innovative technology to help keep drivers and riders safer for each other. Find out more about Safer for Each Other with Uber, partnered by Times Now.
Interesting package, but on to an ET Now exclusive. The Modi government is trying to incentivize airport privatization with a new scheme. Sources tell ET Now that the PMO and Aviation Ministry chaired meetings on this. So what exactly is on the anvil? My colleague Karishma Asudani, who broke this exclusive, is now with us on the phone line sharing exclusive details. Hi Karishma, what are you picking up? Is this going to result into privatization in a much quicker way and perhaps sooner than expected?
Well, right, what we're picking up is actually a modified privatization scheme that government is working on, and what they're planning is a nice privatization mega package that could probably go under the sail. In fact, I'm picking up that PMO and Aviation Ministry officials met last week to decide on selling loss-making airports. They might come up with a policy on clubbing of airports. They may club loss-making and profitable airports together in a basket and could put it under sale. This is, of course, being done to improve the regional infrastructure, but on a broader term, it's being done because with many airports being privatized, it's just the loss-making or the economically unviable ones which are being left with the Airports Authority of India, which is definitely creating a hindrance for its working well. Government, according to my sources, is looking at selling about 6 economically unviable airports with a package of 6 profitable airports in next few months. These are, of course, prelim discussions, but this is third such important high-level meeting on this matter. It's very important because we know that the monopoly of airport privatization has always been with Adani. And if this happens, then in a deal of 6 airports, a private player will be given about 12 airports to work on.
Okay, thanks for that, Karishma. An all-important story. And we'll be bringing you more developments on that as and when they arise. But it's 11:50, we're 5 minutes late, and we have a quiz question and some winners to possibly address. So our question to you once again as part of BNSN Quiz Connect was, which is India's third largest hotel chain by number of rooms out of the listed hotel companies? Your options were Indian Hotels, EIH, Lemon Tree Hotels and Chalet Hotels. And the correct answer is Lemon Tree Hotels. We have 3 winners, Gupta Amarnath, CA Ashok Madrecha and RKJ Rohit. Congratulations to 3 of you, a hearty one at that. And please do keep participating in our BNSN quiz on the daily.
Okay, well, moving on, a whole host of companies on the Lal Street are mulling a buyback, from technology companies to now PSUs as well. The question, of course, is whether shareholders should tender in their shares on this buyback. So on the Money Show yesterday, we spoke to Santosh Kumar Singh, Head of Research with Motilal Oswal Asset Management, on the factors to consider and to analyze whether it's worth tendering in your shares or to hold on to them. Listen in.
the selling decision. So buyback is almost like a selling decision, right? So when you're making a selling decision, one should be clear is that the fundamental value of the company at which you are selling it back to the company is actually lower than or is equal to what the company is offering you. If the fundamental value is significantly higher than the price at which the company is willing to buy back, and generally this is the case because generally companies want a buyback when they see that their share prices are stressed out or they are lower because of not so much of demand in the market for their shares. So if that is the case, and if you find that fundamentally the value of the companies is much higher than what the buyback price is, then there is all the reason that one should not give it back to the company. However, at certain points, one of the biggest reason why people just give it back to the company is because the share prices would have not done anything for multiple years or multiple months, and then they are just annoyed with that actually, you know what, everything in the market is moving up, my stock is not moving up. What will I do of the fundamental value? And here is a buyer who is willing to take back my shares at 5% premium to the last price. So this is where the investors' conviction on the stocks are tested.
That note, completely out of time here and buy now, sell now. Thanks for watching. It's bye from me and Mobina. Keep it with ET now.